And if it goes lower, good. We will buy more. You will see me have $300,000 of Meta if the situation calls for it. Welcome back, everyone, to the $100,000 to $1 million public account series. If you're new to the channel, I started this with $100,000 cash of my own money, trading it to $1 million. All my trades are publicly disclosed. You're welcome to follow along. Welcome to the channel. So today we were up 2,100 bucks. We're recovering a little bit. If you do remember, we did get up to about 131. We pulled back a little bit, but we're recovering and we're right near an all-time high. This is episode 11. We've made $30,000. We made $50,000 in the past 3 months just with smart fundamental trading. No contracts, puts, calls, fundamental trading. So if you look, our buy power went down. We did some buying today. These are very exciting times coming up to the Nvidia earnings because we could be looking at the biggest discount in recent history or the collapse of AI. Now, indexes have been pretty brutal recently, okay? The Dow is very flat, boring, and indecisive, and the S&P has sold off big time over the last 2 weeks. So how are we out here making money when all these indexes are selling off? So as I mentioned, we have pulled back from our all-time highs. Meanwhile, the S&P has lost 1.5% in the last week. So what we're doing right now is using near-term volatility to make profits, to return them to our long-term holds. And by long-term holds, I mean significantly undervalued companies that are just waiting for the narrative shift to return us all our money. So what's looking attractive in the near term, okay? With this Nvidia earnings and the anticipation, everyone has this PTSD from the Nvidia earnings where they have a triple beat, massive revenue, and they sell off. So this hurts the AI ecosystem. Who benefits the most from the AI ecosystem? You could argue Micron and SanDisk. So personally, I think Micron has a lot better business model than SanDisk. So what I do is, in order to not come off a lot of buy power, I do use a 2x leverage on Micron that has a daily reset of leverage. So all we're doing is banking on the near-term volatility. This is not a long-term hold. So we have taken a very small position again in Micron, this time of $6,500. If you remember 2 episodes ago, I got in and out of MUU and we made about 2,000 bucks with a similar size bet. And it just so happened that time, sometimes we get lucky. We pretty much timed the bottom and timed the top. However, I do have some short-term confidence in Micron's ability to recover from this AI muddiness. So we're going to be doing the same thing. We're going to enter with a very small cash position and we're going to run it up hopefully about 25% and get out. Now, the Meta conundrum, okay? Meta is a laughably underpriced stock right now. They're trading at a PE of 20, a forward PE of about 14, real cash flow, real margins, dominant business platform. This is our largest position in the portfolio at $89,000, just under $90,000. They are nearing a 52-week low, okay? Their 52-week low was 520. They're at 559 right now with a 52-week high of 790. And we have to remember that PE ratio of 20 is based off of the poor quarter that they had with the legal fees, the severance pay, and the big AI spend. So if we eliminate some of those outliers and those expenses, their PE would be around 14 with a forward PE of probably around 10. Now, Meta obviously has this big lawsuit in California going on. It's probably going to ping pong around for the near future. And if it goes lower, good. We will buy more. You will see me have $300,000 of Meta if the situation calls for it. If you are a long-term investor or mid-term investor and you have 2 to 5 years where you can set it and forget it, this is probably the safest buy ever. Now, Google. Okay, Google, another laughably undervalued stock. Now, Google is closer to a 52-week high than Meta. However, if you're looking for growth stocks, you cannot be afraid of a 52-week high. A 52-week high means really nothing when compared to the book values. Something can be at a 52-week high and still be grossly undervalued. Not that Google is grossly undervalued, but it's a very safe growth stock. This is our second biggest portfolio holding, around 71,700 bucks. We are $1,000 in the red. I don't sweat that one bit. This is just noise in the grand scheme of things. And again, it's like, let Alphabet go lower. Let it go lower. I will buy more. I will buy until it hits the ground. I was guilty of watching Google go on a 100% run in 2022 to 2023, and I never wanted to get on the train because it never seemed like a good time. Take it from me. Do not miss the train because you're looking for a little discount. Google is at a very fair price, and this is a stock that could weather a pullback of the indexes. The indexes could be red or very red for the coming months. Google will hold true, and once those indexes get bullish, it's the stocks that were undervalued that appreciate the most. Now, Uber, okay? This is a small entry zone, okay? Uber's falling into a very safe range at a PE of 17.32. We did take a small position of $7,800. I wouldn't go selling grandma's house to buy this stock at the moment, but it is at a good price point. I'm kind of breezing through these because I have some very exciting stocks to get to that you guys haven't heard of on the channel. And right here, I call this the safety zone, okay? It's about right in the middle of its 52-week range. Now, I like Uber as an arbitrage play because here's the thing. They don't own anything really but the software. So they really skip over all the expensive stuff. They're not out there buying taxis and investing in mass public transport systems or anything like this. They're just a highly effective software platform that's able to arbitrage a desired service to a customer. Now, the risk. Okay, NVIDIA earnings are Wednesday. Remember, NVIDIA sits on the throne of AI. It's a $5 trillion market cap company, and they ultimately control the AI ecosystem. Now, NVIDIA for the last quarter has been a dead duck. It'll run up, sell off, but ultimately just sideways through the whole quarter. And here's why. You have a $5 trillion company with a 32 PE. Where is the growth? And here's the thing with the $5 trillion market cap. To have a 32 PE, you need to come out with some crazy EPS to lower that PE down to reality. NVIDIA has a crazy support system. Whenever it bounces down to that low 200s, it is heavily supported in that range. However, it just does not have the momentum at the moment to break through these 52-week highs and continue running. Now, this earnings report can completely change that. It can shift the narrative, and NVIDIA could run up to $300+. But they need to come out and be absolutely exceptional on Wednesday, and we'll see if that plays out because they've come out the past 10, 12, 15 quarters with triple beats, and in the last 3, they've just done nothing but sold off. Now, Lululemon. Trading at 123, it has a very clear support system on where it's trading right now. And I can be guilty of being a sucker for a good PE ratio, but here's the thing. If net sales and net margins begin to recede, then a 9.7 is completely justified. So I'm not completely certain that this is a value trap. I'm just heavily cautious before taking a big position. However, I did take a small position in Lululemon of about, let's see, let me move my face here. $6,200. And that's honestly what I call schmuck insurance, okay? I don't want to miss out if there's a big bull run on Lululemon because there most definitely could be. So schmuck insurance is essentially a euphemism for FOMO, saying I at least want to have some skin in the game if there is a bull run in the future. Now, what I'm very excited for. Sterling Infrastructure. So this is a stock that has been absolutely punished this week around the AI narrative, down 15%. But remember, this is why patience is a virtue. This is a stock I've been looking at up in the $1,000 range saying, man, I wish I had an entry on this stock. Look at it, got up to a 52-week high of $993. It really was up in the thousands. If we look back over here, yeah, $1,005 with this 52-week high. But rather than letting our excitement get the best of us, we were patient and we waited and it fell right back into that buy range, right around $495. We have an entrance of $499.25, and we bought a small position of $10,000. Now, before I get into it, if Sterling were to return back to its 52-week high, that would be 100% return. Now, what do? They are the leading infrastructure builder of these AI data centers, okay? The earthwork, utilities, foundations, all of the things that take a bare plot of land to a data center essentially goes through Sterling Infrastructure. Now, they have a PE of 37.24, and this is a bit high. This is a bit high for a contractor. However, they have a 16% net operating margin and an $8 billion and growing backlog. Not to mention, you cannot find an analyst to make a bear case for this company outside of AI sentiment. There is not a company in existence that is immune from sentiment changes. Meta could have the best books, the best backlogs, the best profits, and still sell off around AI muddy waters. And same is to be said for Sterling Infrastructure. But when you buy companies on fundamentals, these are the ones that succeed in the long term. I tell everyone not to be speculative, okay? Don't go out there and say, I like this company, so I'm going to blanketly buy it. But when speculation meets fundamentals is where you get insane returns. And there's an old adage that says, you can either bet on the miner or sell the shovels. And this is as close as you can get to selling the shovel as humanly possible. Now, to summarize, Micron. We are buying Micron using MUU in small positions. Meta and Google are a stack. Uber is ultimately at a small entry. Same with Lululemon. Enter small. It could be a value trap, could not be. use your schmuck insurance, just like I do. BE, this is Bloom Energy. I haven't talked about this one. I don't think I'll have enough time today. Later in the week, I will be coming out with another video, a part 2 to this. That will most likely be post-NVIDIA earnings, so make sure you check out that episode. However, Bloom Energy is fundamental to the AI build-out. And the stock I am personally most excited for is Sterling Infrastructure. I am always very hesitant to say I am excited for a stock. I said it about PayPal, I said it about NVIDIA in 2022, and I said it about Celsius. And let's go back for a second. Let's check on Celsius. Celsius is up 44% since my call out. Now, we sold out. We retained a share just to hang on to it. Look at that, 45%. If you would have hopped on Celsius when I called it out, you would be up 45%. Not to say that Sterling is automatically going to shoot up 45%. However, I am very optimistic around the construction companies building and developing the land around the AI data centers, because whether they pan out to be profitable or not is irrelevant to the fact that they are already built. Remember, guys, we cannot control sentiment. If sentiment goes down around AI, all of these stocks are going to pull back. That's just the nature of the beast. But what we can do is give ourselves the best opportunity for success and to be able to shuttle these gains into our long-term holds. The Metas and the Googles will be around for generations to come. And here is our opportunity to go out and make short-term gains and be able to shuttle them back to our long-term holds. Now, as I said, I could easily see our portfolio bouncing up to the 150, 160 range so long as we're able to get the correct bounce. If not, and we see some pullback, we'll go in and we'll buy more. And I'll put this back on the screen for a second, and I didn't know you could do this, but you can actually filter by your equity in a position. So I'll skim through this really quick. So we have one share of a couple different stocks. We have $6.25 thousand in Bloom Energy. We have $6.29 thousand in Lululemon. We have $89,000 in Meta. We have one share of Amazon. We have $8,000 of Uber. We have $71,000 of Google. We have $15,000 of Microsoft. $1.25 thousand of Uranium. We have one share of UPS, one share of Pulte Homes, one share of Netflix, one share of Adobe, one share of Nike, one share of CRM. We have $1.6 thousand of Constellation Energy, one share of ServiceNow, one share of Caterpillar, $11.9 thousand of SoFi, one share of Nebulous, one share of Sterling Infrastructure, one share of Iron, one share of Rocket Lab, one share of ASTS, 15 shares of Innodata, and we have $6.3 thousand of MUU. Find me another trader that will lay out all of his positions like that. That's a bold move. Now, if you're wondering and you go, oh, well, it seems like you have a little bit more than, $126,000 worth of stock. You're absolutely right. I have about $100,000 of margin used right now in this account. Now, do not use margin if you cannot afford to pay for it. Because listen, if these positions were to go sideways, you need to have the money to backfill your equity in the position. Because if you're on a hope and a prayer and the stock goes down 50%, the bank's going to be coming for you and say, hey, where's my money? Or we're selling your stock against your will. And that's a situation I do not wish upon anybody. So only use margin responsibly and with money that you can afford to backfill. Remember, once we get to 5,000 subscribers, we will have $250 cash going to a random homeless person every $10,000 interval on this series. We've already gotten through 3 of them, so we are waiting to hand out $750 to random homeless people once we hit $5,000. So make sure you like, subscribe, and comment. Now, thank you very much for watching this episode. I will catch you next time, and make sure you tune in.